And we are live. Super excited to be here on this glorious Friday. Hopefully, it's beautiful where you are. I know it is where I am. I'm actually porting in from Park City, Utah today. And my name is Allie Wyatt. I'm the co founder and CEO of Female Founder Collective and The North, which is our incredible expert advisory platform where you can book one on one time with some of the most extraordinary executive women on the planet. Which, speaking of, I'm super excited to be here today with Gosia Karas, who is one of the top women on Wall Street, or by Wall Street Journal, is one of the top women shaping venture capital today. So really extraordinary person. We get to pick her brain, which is a very unique opportunity. I also, before I sort of get into her background and the extraordinary things she's done in her career, wanted to really quickly mention and remind everyone, if you are not coming, you should be coming. We have Female Founders Day, our biggest event of the year, coming up in celebration of International Women's Day. And that's going to be on 3/23/23 in Los Angeles, California. It's going to be downtown. We're going to be sending out information about hotel blocks as well. If you want to join us from another part of the country or another part of the world, we'd love to have you. But without further ado, I'm going to give you a little background on Gosia, because she has a long list of accomplishments. So as I mentioned, recently was recognized by Wall Street Journal as one of the 9 women shaping venture capital, and by the Venture Capital Journal as a rising star. She's an investment director and co-leads the SoftBank Opportunity Fund, heading up its growth investment team. Previously, she also worked with SoftBank's $5 billion LatAm Fund and served as SoftBank Group's Silicon Valley deal team. Her investments include Upside Foods, which is formerly Memphis Meats, 8 Sleep, Drift, PlayVs, WelcomeTech, Loggi, Konfio, and others. She is interested in B2B software, AI platforms, and the future of food. The Opportunity Fund that she's working on actually launched in June 2020, very timely and very needed, as a $100 million commitment to invest in Black, Latinx, and Native American U.S. founders. It launched in just 24 hours, which is insane. We need to dig into that, Gosia. Built on SoftBank's core belief that more underrepresented founders would build extraordinary companies given the chance, the network, and the capital to do so. And prior to joining SoftBank, she was the senior associate at the deal team at Onyx, $44 billion AUM large cap private equity firm in New York, and strategy consultant at Bain & Company. She graduated summa cum laude from Warsaw School of Economics as valedictorian. And she received a PhD in finance from the same institution, was a Fulbright scholar at Columbia University, and holds an MBA from Harvard Business School. So I don't know if there are many people on the planet who are as well educated or awarded as you, Gosia, but I want to dive into, actually, I want to go back to that 24-hour launch just for a second and hear how that possibly could have happened in a 24-hour time span, that you were able to activate $100 million to start to allocate.
Of course. Well, we built the fund, of course, within the SoftBank broader platform. And our thinking at that point, and as you guys may remember, it was June 2020. It was when a lot of debate and discussion was happening in the country around racism, around inequality. All of that was very much front and center. And we didn't want to be a company that just puts out a press release. We really wanted to do something, and we wanted to do something that we know how to do well, that can really drive change. And at the same time, which is obviously important for anyone who manages capital, do well and create financial returns while investing in underrepresented founders. So the thinking was we can do both at the same time. We can really drive change and create value. So we decided to do it, and it was a very easy decision really to make. We put together a team very quickly and started investing the capital. We got, of course, buy-in from Masa, from Japan, from the whole SoftBank Group, and we got to work. And I believe we did our first investment out of that fund in about a month after launching. So it was really quick, and we are now at 75 portfolio companies. So
Wow, 75.
yeah, across all stages. What was very interesting was it was the first time in many years when SoftBank decided to go beyond mega growth deals and go early. And we, as a firm, decided that this is the right group of founders to pursue that strategy and to make that kind of shift a little bit from what we typically do. And so the reason why it's so many companies is because many of them are early stage, which is not standard for SoftBank, but very much a worthy exception.
And Gosia, how do you define early stage? Because I think there's probably a lot of founders on here, and there's also, Series A is becoming much larger than it used to be. Even seed, I think, might be somewhere around an average of $5 million investment. So, what do you consider and qualify as early stage?
So we would go as early as seed. And the way we define it, I mean, every founder really defines it, right? The founder tells you, hey, I'm raising my seed round, or I'm raising my pre-seed, or whatever it is. But what we are looking for is companies that already have at least a little bit of traction, at least some evidence of product market fit. Maybe, $20, $50, $100,000 in revenue. Maybe, well, yeah, typically it's frankly revenue, because that's the clear.
That's how you define product market fit for the most part?
No, that's how we define something that is already investable for us.
Okay.
Product market fit is a much bigger thing, and it typically takes much longer to really prove it. But what we're looking for is some just very early evidence that there are buyers for what the company is creating.
And a lot of people, I was actually just in a conversation with some women in our community yesterday, some of the founders, and they asked about that, right? They're like, what is product market fit? How do you define that? How do investors see it? And I answered that a lot of times it's sort of self-defined by the company, and you've sort of put together your own traction metrics. But do you have certain benchmarks when you're seeing when you feel that product market fit has been validated? Are there certain sort of things you're looking for, signals?
So we always start, and that's what every diligence process, in my opinion, should start with, is just understanding what is the fundamental problem that the company is solving and whose problem that is. And that's the start. And really, at every stage, a company can sort of tell you that. There are sometimes businesses that start more with I have this cool technology that I am trying to build, and I am hopeful that I will sell it to these or those kinds of buyers. That tends to be a much harder path to be successful as a business builder. What I like to see personally is, I don't know, I worked for a company X. I realized that their product is not really solving that part of problem for our customers. So I decided to solve that, and I am building a company that is solving that. That's a really good start. Just a very clear definition with what you're going to achieve and for whom. And then the product market fit evidence sort of starts there when the founder can say, well, these are the first 5 customers that I already have. 3 of them are still in pilot, but 2 I have already converted, and they are already paying me, and I have a long-term contract with them. That's important. And that's the first evidence. And then as you look at companies becoming more and more mature, you get more evidence over time because you have more of those customers that converted. If it's a consumer company, you see more of, I don't know, evidence that the app is being used every day by this or those number of people, and those numbers are growing. It becomes very different depending on what business model we are talking about, but over time there is more and more typically numerical evidence that comes from it. But at the beginning, it's just the first couple of people that bought your product that are using it. And as an investor, we would typically try to talk to them and really understand, are they really committed to using that particular solution? What does it do well for them? Where perhaps might it still be lacking, and how likely are they to keep going in the relationship with the startup that we're looking at?
And I know that in your bio, it mentions the types of industries that you invest in, Gosia, but is there a certain philosophy you bring to the table, both for the Opportunity Fund as well as maybe for yourself personally, that you use as a lens when trying to identify the right businesses to invest in?
Well, every investor always has certain sectors that you are focused on, in particular at the moment in time. It's not, it typically doesn't define you for your entire career. Sometimes it does, typically not really. But there are certain areas which you are particularly excited about at given points in time. For me, I have been following AI for a very, very long time, since the kind of revolution in deep learning that happened in like 2012, 2014. And I was kind of waiting for this whole market to really erupt and for companies to start being built really beyond the platforms. And it's happening now, which I am very, very excited to see. From the more philosophical point of view, I mean, again, I keep coming back to what problem is really being solved here and for whom. You often find pretty good answers to those questions within software, and software is, of course, the darling of the venture capital industry. So I spent a lot of time. I spent a lot of time there, but I like companies that have clear definition of what they are doing. I like companies that have either big markets or markets that are a little bit more niche-y. In particular, when I invest at slightly earlier stages, niche markets are good because you can get more entrenched with the customers that you are serving.
Do you have an example of a niche one, Gosia, that you could reference?
So one company that we are very, very excited about that we have in our portfolio is a company called Resilia, which we invested at very early stage, I believe at Series A, and they just raised their Series B, which we were lucky enough to participate in as well. And it is a software company, but what they are doing is they are working with nonprofits, and it's a platform for nonprofits to be able to manage their business as well as to connect with people who can provide them with capital. And it serves both the nonprofits themselves, but it also serves the providers of capital to nonprofits. So you create this really nice flywheel where a funder can realize, hey, some of the nonprofits that I have in my portfolio are using that software. I can use it too, and I can see it in real time what their dashboards look like, and then I can deploy it also to other nonprofits that I work with. So it creates this really, really nice network effect. But it is more niche than what you would typically think of in venture capital, right? Because that market is not as massive as the market for Uber or the market for Airbnb.
So would you say it's important for the founder to either occupy a large portion of a niche market or to have a large addressable market that they're going to be able to have a competitive edge in?
I think that very much depends on what business you are building. I
Okay.
think that there's definitely opportunities within software to build niche businesses, and people have been doing it for a long time, and not necessarily even taking venture capital for those sorts of companies. A company like Resilia wouldn't necessarily need to raise venture money. They can be very, very efficient, and they can bootstrap to a certain level and then sell themselves to private equity. So there is a number of companies who don't necessarily need to raise venture money, in particular in software. I don't think that there is one answer, really. I think what is important as the founder is to define what you are, understand how what you are doing matches different models of financing that you can get, and then go after those models of financing. And for niche businesses, it won't necessarily be venture capital.
Got it. And as far as the level at which you invest, so you were saying you'll go as early as seed, but you also will do later stage, more growth oriented businesses, right? Is there a certain portion of ownership that you want to take in these particular businesses when you invest? A certain check size that you like to write?
So many funds do that. And from the founder's perspective, I know a lot of folks in the audience are founders themselves. It's important to understand this from every venture fund that you are talking to about what their targets are. For us specifically, for Opportunity Fund, we weren't going, and we aren't really going for specific numbers in terms of ownership stakes. We are very flexible capital provider. We can lead deals, but we can also follow into deals led by others. So we're probably more flexible than I would say majority of the market is. But what you would typically see is funds will say, well, I want to have 15% or so if I am investing at the Series A, and I will only lead deals. And that's okay. This will be one group that you go after, and then you will fill the rest of the round with people who are followers or who are flexible the way we are.
Got it. And so there's not like a certain minimum check size that you'll do, or ownership threshold. So that's
No, we have written checks, just to give you ballpark. We have written checks all the way from 100K into very early stage companies. These were not typically written by me, but we have team, of course, who does that, all the way down to high single digit million out of our $100 million fund.
wonderful. So very broad range. And Gosia, when you look at founders of those earlier stage businesses that are in sort of building mode, versus founders that are in more growth stage, how do you evaluate, and what sort of benchmarks are differentiated between the two, and the process that you use to ensure that it's a good investment for you?
So the process of pitching a company when it's an early stage business versus a growth company is a little bit different. You will still talk as a founder about the very same things, but the emphasis will be different. So at early stages, what we and most investors, frankly, are always looking at is the founder and the team, the founder market fit, in addition to product market fit. Of course, as we talked about what problem you are solving, what your market looks like, who your competitors are, etc. But a lot of that is really selling on the vision, because you don't necessarily have, when you're just launching a company, you don't necessarily have a lot of numerical evidence to, how much you're able to sell, what's your specific unit economics is going to look like going forward, and those sorts of things. It's really, really hard to have those quantitative proof points. So a lot of the discussion is more qualitative and more, this is me, I am building this is my vision. The more later stage we go, the more quantitative the discussions are. And that's when people like me, I of course come from private equity background, so I am very focused on the numbers when I'm doing diligence for slightly later stage companies, Series B and onwards. That's when we would really go through the numbers. And by the numbers, I mean even very granular data, like every single contract that you have in Excel, we would analyze it. We would try to get a sense of how much people were paying you in the past and how much they are paying you going forward. And are you able to upsell them, to cross-sell them? Are they churning? How much of revenue dollars are you retaining? How does that translate into how many individual clients you're retaining versus what happens to your unit revenue? All of those things we will really go very deeply into. And especially now, of course, the market has changed from the last year. People, including us, are even more focused on your path to profitability and on understanding unit economics, but also the profitability at the more company level. So a lot of the discussions on the growth stage side are very much around that. So we would still talk about you as the founder. We would still talk about the team that you were able to assemble. We would still understand your competition. We would still call your customers. All of those things that are there for the early stage would still happen. But on top of that, there would be this whole body of work that needs to be done on the quantitative side. And it changes the way you pitch, because you have much more of numbers to really refer to and to show for your success and for your traction.
Right. And as far as the when you're looking at sort of founders that have made it to that later stage, right, that are more growth oriented, Are there certain characteristics or patterns that you've been able to identify that you might be able to share as insight for those founders that are sort of coming up and trying to scale their businesses, that are sort of indicators of success for future?
I think that the big change that doesn't happen like this, but it's kind of gradual as the company is growing, is the founder's role kind of changes from being a jack of all trades and really doing everything into becoming closer and closer to the CEO of a public company in a way, a person who manages. And what is very important as that transition happens is what sort of people you are able to build around you, what your executive bench is going to look like, what's their background, how great they are, and how much you are really able to leverage them and their ability to scale the organization underneath them, and abstract yourself more towards the role of the general manager of the whole thing, of the strategist, of the person who works closely with investors and who plans the next chess move. So ability to attract really high quality talent, not just at the individual contributor level, but also at the senior level is very, very important. And the people who do it well are able to really build great organizations. And that typically happens around Series B-ish, that transition where it's more, these are the executives I'm bringing on board, and they take on a lot of what I as a founder have been doing, typically happens around that stage.
Are there any things that are indicators for you at the early stage business that they're going to be able to achieve those sorts of things, right? That they're going to be able to recruit talent that's exceptional? You know, is there a way to sort of gauge for that as an investor with somebody that's just on the beginning of that journey?
I think that what happens a lot is that you often see people with just history of general success in whatever it is that they were doing before, and that comes in so many shapes or forms, but it tends to always be there. And that gives some sort of evidence of whatever that person is touching can really become great. I think that's important. On the purely team building side, you see it pretty early as to what even is the initial talent that comes on board, and how the team works at the very, very beginning, what does the culture look like, etc. But it's very qualitative. A lot of the,
Yeah.
I am more of the numbers person, of course, but I have worked with
Hard to quantify.
Yeah, I think it's impossible to quantify. A lot of it is really the day-to-day is a lot like interviewing people in a way when we're talking about early stage investing, and just finding that talent, and you train the neural network within your own brain as to what excellence looks like, and then it just spits out the answer in a way.
I love that. And obviously you mentioned that June 2020 is when you launched this, right? There was a lot of sort of racial unrest and a lot of inequality within the United States and in the world, frankly. It was a big topic of conversation. But was there a quantitative reason or a specific reason that you chose those underrepresented founders that you're focusing on?
We had to draw the line somewhere. And the thinking was, this is where there is the biggest problem. I mean, at that point in time, it was ballpark of like 1% to 2% of venture capital going into the hands of racial minorities, compared to, I want to say, like 30% or so of the population in the States. So that mismatch is just stunning.
Yeah.
And our thinking has been and continues to be that talent is distributed equally, but opportunity isn't. So there must be some like very strange and reason as to why that capital is not flowing there, which creates opportunity to do the right thing, but also opportunity to invest money for profit. And our thinking has been and continues to be every single day that this is not in any way a charity effort. We invest the capital that SoftBank Group provided to us with the very same mindset as we invest the rest of SoftBank's capital. When we did Latin America fund, the thinking was very much the same. We want to find very high quality investment opportunities. We want to bring capital to them. We want to grow with them. We want to double down when they succeed, and all of that. And it's the exact same thinking. And that's very, very important for us, because the logic we had already at the beginning was, one day we don't want funds like ours to have any reason to exist. It should all be equal. But the only way to get there is to show that you can make money when you invest in those groups as well.
And are there any particular types of businesses that you're seeing underrepresented founders are starting, like a pattern of different types of businesses?
So this is a common assumption that people from certain groups will try to find and solve problems that they see in their daily life, and these problems might be perhaps slightly different than what the majority is most frequently seeing. I don't think that's really true. I mean, we have seen, and we have companies in our portfolio really all around in terms of the problems that they are solving. We have all industries represented. We have crypto, we have fintechs, we have software, we have health tech, we have ed tech, we have literally everything. And that's great. And those companies are doing really, really well. So we're proud of it, and we're happy that there isn't really a pattern. That it's not like impact equals underrepresentation or anything like that. It's more great people starting great companies.
And now I want to talk about you, because obviously you've had a tremendous amount of awards under your belt, but particularly you've been called a VC to watch and a rising VC stars. What deals or traits stand out to you that have contributed to these distinctions, or why do you think you've been able to succeed in this industry?
I mean, of course, I'm very honored by those distinctions, and obviously receive them among many other incredible venture capitalists. So very honored to be in those groups. I think, you know, what mattered and what I am very proud in my career is the fund building muscle that I somewhat built in addition to purely investing, which has been tremendous. I mean, we really, with Latin America Fund, we feel like we catalyzed that continent from the growth equity standpoint. And really, when we started investing there, after us, a lot of other people came, and it really helped kickstart the later stage investing on and put that on the map of Latin America, which has been just fantastic, and a ton of joy. And it has been and continues to be a big joy for me to kind of do the same with Opportunity Fund, and to that way again sort of expand what SoftBank typically does, because we are most known for mega growth deals, and the ability to build something in addition to that, may it be in LatAm or may it be on the earlier stage side within Opportunity Fund, while of course doing all the great other things that we discussed, that has been a big joy. But at the end of the day, you can really only evaluate a fund or an investor when they exit, right? It's you need to show DPI, distributed to paid in capital, and it takes time to show it.
Yeah.
So, you know, maybe we'll talk again in a couple of years. I mean, for now, I'm proud of my first exit, which is a company called Drift, which was really good for us financially, with an Opportunity Fund. But we have it's a tremendous privilege to be working with the companies that we have in the portfolio who are not ready for exit yet,
Yeah.
who are performing really, really well and growing and raising subsequent rounds of capital. We just had our portfolio company QuickNote raise their Series B, and we have been with them since their seed, and it's a tremendous outcome, and they are doing really well. It's just fantastic to be let in to work so closely with the founders who are devoting their whole life to, again, solving a particular problem, and we can be there and working with them hand in hand, and advising and providing capital, and that's just tremendous joy.
And a lot of times people talk about venture capitalists as futurists. I very much believe this. It's you have a really good gauge on what might happen in 5 years and in 10 years. But my question for you, Gosia, to sort of wrap us up is, what in 2023 do you think is going to happen or emerge? Are there specific types of companies that you're really excited that you think are going to have an explosion of growth? Or are there certain types of companies that you're hoping will start that haven't been started yet? Or are there, do you think that the VC industry, in light of everything that's happening with the economy, will shift their way of doing things and thinking?
So I think, of course, the economy influences the way venture capitalists think,
Yeah.
and it affects the math. So of course, it affects the way we do investments. But I mean, we'll see. Here, it's really hard to tell. Of course, the market has come back to being a little bit more measured than it was in 2020 and 2021. It is true that it is a little bit harder to raise venture capital. People are more cautious with deploying the funds that they have raised. I think that's kind of healthier than what we have seen over the last 2 years. But it is a harder environment. That's for sure. It's not going to affect the high quality companies, but it will just make it harder. The processes are already longer. Takes more time to raise money. You probably can expect to raise a little bit less than before, and that's all right. That's healthy. We're just back to the usual programming after the craze of 2020 and 2021. On your broader question, I wish I had a crystal ball. I am, of course, and I think I said this before, I am very excited about the recent developments in AI. I've been following this for so many years and waiting for that moment. So for me, it's just, yes, finally. But the open question here is, how will the value really accrue, and who are the players who are going to win based on this mega trend that is really materializing right now? Will it be the platform companies that will kind of capture most of the value, the OpenAIs, the Anthropics, the Google DeepMinds, and all of those guys? Will it be the big tech companies who will partner or buy the platform companies and then put those products into whatever they already have and use the massive distribution engine that they already have? Or will there be space for new companies to be built? And where are they going to sit in the value chain? Are they going to build their own models, or are they going to leverage the platform companies? And depending on which model they choose, what will the value creation for them really look like? I think this is the most critical question for the generative AI craze that we are all experiencing right now, and for anyone who is building companies in that space. Figuring out where exactly you want to play and how you expect to monetize, given the overall market structure that's kind of still forming, is going to be critical. But I am very, very excited about that and about what we are going to see here.
Well, wonderful. We are very lucky to have you today. So thank you so much for the time. And we're also very lucky to have you investing in founders that need the capital. I loved what you said about the fact that talent is equal. It's just that opportunity is not. And so let's all collectively come together and be very deliberate and intentional about ensuring that those two get much closer together. So thank you for doing all that you do. Thank you for being here, and have a wonderful weekend. And we'll definitely be sending founders your way, I'm sure, because we have many thousands that are looking for people like you as a partner.
Very much looking forward to it. And thank you so much, Alison and team, for having me. It was an absolute pleasure. Thank you.
Thank you.